So there's a couple of different ideas going into NVIDIA earnings. I believe it will move the entire market. Today, don't forget, after hours today, NVIDIA will have earnings. Just remember, we're going to be like, oh, but they beat earnings. Okay, it's projected that they will beat earnings, but that does not mean the stock will continue to climb. Typically, a stock will drive up until the event and then sell off. We call that buy the rumors, sell the news. But I'm always like, listen, be careful. A couple of days before the event, there could still be a sell-off. And then you'll hear everybody, oh, it's baked in. What they mean by that is because all of the driving force to get to that point, it's already there. So by the time the news comes out, everybody's already bought it. Now they want to collect the profits from that, okay? It's not always. Sometimes they come out with ridiculous earnings and incredible forecasts is coming up. They're like, we're going to sell $87 gazillion more like in the next week. We got all these things, and that'll continue, obviously, to drive the market. So what do I mean by all this? We don't know with earnings, okay? So before you all go loading the boat with your checks and like, oh, I'm going to just, this is gambling, I'm going to go all in. Don't do any of that. Thinking it's going to go one way or the other, especially with options, because guess what? With options, ladies and gentlemen, you don't get to sell them after hours. So if you make a mistake and you bought the wrong way, you are screwed. You do not get to sell them again until 9:30 a.m. Eastern tomorrow. Now, there's another way you can trade this. You can run what we call a straddle. Call option and a put option with the exact same strike price and the exact same expiration date. That is the pure definition of a straddle. Now, if it was during regular market hours, it's a lot easier, right? If it breaks below this level, kill this, let this one run. So if it decides, hey, it's great news, it's running, yay, and you would just stop out your loser, which is going to be, right, your put option to the downside. You just go, okay, forget it. I just want to be long and let the long run. The problem is it's after hours. There is no stop, right? So one's going to go up and one's going to go down. But here's where the magic could happen. If there's enough volatility, let's say you have a call for 100, which is to the upside, and a put for, we'll say 120. Puts are usually a little bit more expensive. But anyway, so 100 each. Right? Well, if after hours it decided to go crazy to the moon and NVIDIA runs up 7 to 8%, and we've seen it do that, okay, great, because usually that would be enough where it would completely cancel out the loss of the put, which is $100. Because remember, if one goes up, one goes down. So as soon as one gets to 200 and the other to 0, you're now break even. So now at the bell, maybe it's worth 250, 300. The other one's 0. Okay, that's when you make your money. But there has to be enough volatility for one to completely replace the cost of the other one and then continue to run. If you have a bias more on one side than the other, you can do what's called a You do not have to have same expiration. You do not have to have the same strike price. You could run them the same, but let's say you're like, well, I think that it's going to go long. I might put 80% of my money towards a long or a call and 20% towards my short or a put. Obviously, if that goes against you, you're going to lose bigger on the side that you were wrong on, but you have a little bit of a hedge, okay? Your 20%, if it did run enough, could pay for the 80% or get you real close. So all we're doing there really is we're just trying to hedge against what if I'm wrong. That is a okay. So I'm not telling you to use these, but I'm saying these are different strategies that I like to use. And if you've been here longer than 30 seconds, when in doubt, straddle it out.